Okay, hello guys, my name is Gavin. Welcome to Alphachain's Market Breakdown webinar. So this is where we're going to break down a specific strategy, or we're going to break down a particular asset. The focus of today is pivot points. Pivot points is one of my favorite indicators, secondary indicators used. It's also one of the part of our strategies that you cover on the trading, and I tend to see a lot of traders using pivot points. So it is a sort of trader's favorite indicator. Now, if I have to say where does it come within sort of the top 5 indicators used, it's up there. It's up there. It's not number 1. It's not probably number 2, but it's probably number 3 from my experience in finance and in trading. But okay, what I want to do is keep this interactive as well. Okay, so I'm going to break down, do an introduction into what are pivot points, go into some of the pros and cons around pivot point trading, go through some of the examples on the chart that I have here, which you should be able to see. You should be able to see my screen, and ask questions, guys. This is a perfect time for you to ask me questions. I'm not sure why this just keeps going off. Okay, so do ask questions. Okay, let's get into it. So what are pivot points? So they are seen as significant levels applied on the asset that you view on the chart itself. It's not an oscillator, it's on the chart itself, on price action itself, and it can be used to determine key levels of support and resistance. So it determines key levels of support and resistance. Yep, so key levels of support and resistance is determined through these pivot levels. Now, it's generally used as either a directional move, so you're looking for a directional play, or you're looking for a reversal. What I mean by directional, you're looking for that momentum, the break through the pivot point, and then you look to trade it to that in that direction. Or it can be used as a reversal. When it reaches one of those extreme pivot levels, you look for some indication of reversal, and then you potentially sort of fade that particular asset. Okay. So the PP level is your average. That's the sort of the main, that's the pivot point itself. That uses the prior days high, low, and close, and then you divide it by 3 to work out the average. Okay. So what it's doing is it's estimating what the future PP level is, what the future average price level is, right? And then there are additional calculations for the 3 resistance levels, R1, R2, R3, which you should be able to see on the chart over here. So if I just sort of zoom out. Okay, so you have the pivot level, this pivot level over here, that's defined from the previous day's high, low, and close. Okay, so what it's going to do is going to look at, okay, this is that one trading session. Okay, so it's going to take the one trading session and it's going to indicate, if I just can work out what the pin is, okay, indicate that being the low, that being the high, and where it closes. So it closes somewhere in this region around there. Yeah, so it's going to work out the sort of, the average of this. Obviously, these two sort of are quite close to each other. This is quite far off. It's going to be sort of skewed more to these two, the high and the close. And that's where the pivot level is currently. Okay, so let me just undo this. So yes, it's worked out from the yesterday's high, low, and close, and it gives us the average where the PP level is. There are additional calculations, which is actually in the course material. It's within the course material. You can do a simple Google search of what are the pivot point calculations and work out R1, R2, and R3, and S1, S2, S3. It is using the same information in regards to sort of pivot points, but has a slightly different calculation, a more in-depth calculation. To work out these levels. And what it's working out is what are your key resistance levels. Your R1, your R2, R3 are your resistance levels. Your S1, S2, S3 are your support levels. Now, one of the most important aspects in regards to pivot points is the fact that it's a predictive indicator. Okay, it's a predictive indicator, right? It's not using a lot of information. Is using the previous day's high, low, and close, and then it's got specific mathematical calculations or formula to it to define where price may react, may be a directional move or that reversal move. So it is seen as a predictive indicator. It is also a potential leading indicator, right? Leading meaning that it could tell you where price could stall in the future, or where it could reverse or break through in the future, right? So it's seen as a predictive to leading indicator. Now, there are different versions of pivot points. I've seen Fibonacci pivot points. I've seen DMARC pivot points. Generally, I tend to focus on the standard pivot point level. Standard pivot point. Remember, part of using the technicals is that it's a self-fulfilling prophecy. You want to see what others are mostly viewing, and standard pivot points are one of the most popular indicators used. Therefore, that's why I tend to sort of focus on these standard pivot point levels. Are you guys with me, guys? Are you still with me? Give me sort of a heads up. You're understanding everything that, and if you have any questions, give me a yay or a nay. Okay, yay. Right, so where do pivot points come from? That's part of it. Let's talk about a bit of its history. So originally, when you had those the pit traders, right? These are your floor traders. Okay, when they're in that open outcry of all of these different types of traders, clerks, and so on, looking to buy and sell against each other, right? Did they have charts? They did not have charts. What they would have is like what I can see here on my TV screen at the bottom of Bloomberg. You will see the asset prices. You see a scrolling ticker or ticker board where you see all the current asset prices. So floor traders used to take that information. They'll take the previous day's information and define using this calculation where the key levels are, where the potential key reversals could be. And that's how it came into place. So it was originally designed and used by floor traders. And those floor traders did migrate onto becoming electronic traders. Majority of them went on to become electronic traders, and they just simply applied that indicator there also. Okay, so that is why it's very a popular indicator, and the fact that you had professional traders using this prior on the trading floor in the open outcry is why it's heavily, or it is regarded quite a very, very strong or significant indicator. Yeah. Okay, so the key point there is, remember, these open outcry sort of situations where traders are trading against each other, they're trading on the very, very short term. Okay, so that's why this is mostly focused for day traders. Okay, so the time frames you must use are the lower time frames. I don't want you to be applying this on the daily and the 4-hour time frames. No chance. Focus on the 1, 5, 10, 15-minute time frame. Maybe the 30-minute time frame. I've used it on the 30-minute time frame previously. So this is what it would look like on the 30-minute time frame. But again, it's not so great, right? You're not seeing a lot of price action movement. You want to see a lot more candlesticks to this. So this is the 15. This is the 5. And some traders even view it on the 1-minute time frame for further opportunities. Okay, so it can be applied to those lower time frames. It is there for intraday trading, guys. It is there for intraday trading. Is there a pivot point type that allows for a greater range of movement? What do you mean by greater range of movement? Right, so, I mean, are you defining in the distance between each pivot point? Give me more indication of what you're looking for there. Right, okay. So yes, in discussing sort of the time frames, ideally I'd prefer you to look at sort of the much lower time frames. Look at the daily pivot points, which is taking each day's worth of high, low, and close information and defining your PP level, and then working out R1, R2, R3, S1, S2, S3, and then trading it on the 1, 5, 15, maybe even the 30-minute time frame. But if you are looking to transition to sort of those higher time frames and using pivot points as a way of trading, I have seen traders look at the 60, so the 1-hour time frame, the 2-hour time frame, 4-hour time frame, and look at the weekly pivots. So that's the the entire week's levels of high, low, and close, and then the calculation from there. Okay, but again, that's a percentage within a percentage of who uses those time frames with those weekly pivots. Okay. So that'll be mostly swing to position traders, and there's a small amount of them actually applying pivot points as their way of taking trades. Okay. So just to highlight some of the calculations behind the S1, S2, R1 and R2, the calculation behind them, if I can just bring up something, just give me a second. Okay. So that is the calculations. As I mentioned, the pivot points, the high, low, close, divided by 3 gives you the current, the upcoming pivot point level. Support level, so to work out sort of the S1, it's P. So you get the pivot level times by 2, then you subtract the high. If you're looking at R1, then it's again P times 2, so the pivot level times 2 minus the low in this case. For S2 and R2, you're looking at the P level, but you take the high and the low, subtract that, and then you take subtract the P level. Whereas if you're doing for R2, you're adding the pivot point once you've subtracted the high and the low. So a little bit more technical. Generally, what you can do is you can put it into an Excel document, the calculation, and you just put in those price levels and it works it out for you. There are online calculators that you could use, an online pivot calculator that you can use. Let me just see if I can bring that up. I'm pretty sure you can download that also, right? So here we go. So here is an online calculator. Okay, so you just put in the open, the high, the low, and the close, and this will work it out for you. Okay. So yeah, ideally you shouldn't be looking to work out each pivot level. Okay. So I was trying to see if there was a pivot point, standard deviation each side. It's not based on standard deviation though, right? It's not like a volatility type of indicator, right? Standard deviation is about making a definition based around the current volatility, right? That's why I'll probably encourage you to look at the Bollinger Bands, and on my next session I might even go into Bollinger Bands as a way of how to use it and so on. But pivot points are totally different, and I mean you'll often find that, right? The fact that if you do a back test and a forward test and you see that often that pivot levels are not being respected, so why include it, right? Why add an additional indicator or find a specific calculation to the pivots that may be adjusted to that market, right? So that's where over optimization for that indicator to that asset is not the good thing to do. It's not a great way of going about it. If it doesn't work, it doesn't work, right? The whole point is to find indicators that work with that asset rather than over optimize that particular indicator. Yeah, and that's what I mean. If you look at moving averages and the crossover of two moving averages as a way of your strategy, the parameters behind them can be over optimized and often it doesn't work in the long run, right? Okay, so moving on, so let's focus on the actual sort of application of it. So how do you apply this indicator? So you'd ideally sort of go to your indicator list, and then from there you search for pivot points. If I do that, and pivot points standard on TradingView. On MT4, most brokers most applications allow you to it's already a it's already an indicator on their indicator list. So you shouldn't have an issue, but some may not have it. And that's where you may want to download an MT4 version of that. I do have one, so if you do need it, I have it already downloaded somewhere. It's on my PC somewhere. But I mean, quite popular ones that you could use is this one over here. This is often used, the FXSSI one, so pivot points all in one, right? So for those turning points, right? Okay. So yeah, if you need the custom indicator, either send me an email or just do a simple Google search and you should be able to find an indicator that you can download and install into MT4. If you're having issues on installing sort of new applications, new indicators, expert advisors onto MT4, let me know. I can sort of also potentially help you out there also. Yeah. Yes. So now let's sort of focus on the application of it. Okay. So at the start of the day, one thing to sort of put an importance to is where that PP level is. Where that PP level is, because it's often that price is going to be either at the PP level, slightly above, or slightly below the PP level. Right? It's just starting its day. Right? Generally, you don't want to be taking a trade within the first 15 minutes, first 30 minutes of that, of that trading day. You'd want to see what takes place, right? Does it continue against the PP and just goes on to sort of rise or fall, depending on which side it opens, or does it come back and retest that pivot level? So in this example, you can see market opens quite close to the PP level. If I just zoom a little bit more so I can sort of start to build that picture there. So this is where the open is, the vertical line over there. Market sort of starts to move away and then it starts to sort of retrace back to the PP level, and it does test the PP level. Okay, it does go into test the PP level, and thereafter pushes up higher. Yeah, so you need to find opportunities. So that's the first thing. See what price does just around the PP level. See, what is it trying to do? Is it stalling at the PP level? Is it showing a lot of rejection at the PP level? And be precise with your analysis. Wait for price to, really test that PP level before you decide what you're looking for. Okay, that's the first thing I'd probably say at the start of that trading day. The next step is to go back and really sort of look at the bigger picture. It's so important you guys look at the bigger picture. You could assume, yes, this is a great long opportunity to go over here, but there's an overall downtrend in this case, right? So there's a series of lower lows, lower high, another lower low, lower high, then it goes into another lower low, and so on. So look at the bigger picture, and that's where you apply your own subjective support, resistance, trend lines, channels, and so on. Okay, so do apply your primary analysis. That is, it is subjective, but it's your primary analysis. Okay, and something else that I like to do is the fact that I like to look at if there is a confluence with previous days support from pivot levels. Okay, so is there a confluence between previous days support and resistance pivot levels? Okay, you can see my S1 is also in line with a PP level over here. So I might track back and look at sort of maybe 3 days worth of data, right? So I might look at sort of 3 days worth of data. Might have to go sort of slightly higher time frame. Look at 3 days worth of data, and if you see often price holding a specific a pivot level holding a specific price region or price level over sort of last 2 or 3 days, that could be a very strong indication that there could be a large reversal coming in at that place. And look at the sort of R1 here, R2, and R3. That's 3 days in this region here, right? It's staying around this region here. Also, it's the most recent high. You got a round number, spot 95. So next time comes here, I can pretty much confirm that there will be a reversal, right? How much a reversal, I don't know, right? That's where sort of analysis close to time comes into play. But you will expect a lot of selling pressure to come in this region here. Yeah, and yeah, so look for confluence through a number of prior days pivot levels. Price doesn't respect the pivot points on crypto very often, so I was trying to see if there was a pivot point that has a certain standard deviation. Did I? Yeah, I think I answered that already. Okay, guys, come ask questions, guys. You should be asking questions. The more questions, the better. Okay. Yeah. So the first point is at the start of the trading day, don't rush into the trade. Look at the market, see what it's doing. Okay, is it, how far is it above pivot point or is it below the pivot point? If it's above the pivot point, your instinct is that you should be looking for long opportunities. If it's below the pivot point, you're looking for short opportunities. Okay, at some point, it might just continue going away from the PP level, or in other times, it might be coming back to the PP level because there's not enough influence or not enough sort of momentum in that asset to define which direction it's going to actually go. Yeah, that's the first step. The second is zoom out and look at sort of, what is the overall major trend? Is it in a long-term downtrend, uptrend? Is it consolidating, right? Is there a key levels of support and resistance that you can define? Apply your trend lines, your channel lines, and so on. And then the third key point is to then look for confluence in these pivot levels. Look for confluence in these pivot levels. Then also look at round numbers and other confluences. So confluence is key. So those are 3 steps to start off with at the beginning of that day for that indicator. So that's the setup almost, right? Well, I wouldn't say the setup. I would probably say that's the sort of pre-market checks that you will need to do in regards to pivot points. The setup would be is when price retraces or bounces or comes to close enough to one of those pivot levels. Okay, so when price reaches one of those pivot levels, what are your next step? Okay, so you're waiting for that confirmation to take that trade. Okay, so when price comes to that pivot level, how many confluences do you need, right? Or do you need none? Do you just want price? You're happy to take all positions as long as it comes to the PP level and you see candlestick confirmations. You need to define how much confluence you need. The more confluence you need, the harder it is to get into lots of positions as well. Okay, so you start to reduce the amount of trades you will take because you don't meet those amount of confluences. So start off somewhere. Start off somewhere with maybe say just one indicator. Okay, I'm just taking on the pivot points. Right, I'm going to go with what I said with the 3 steps of pre-market sort of setup. Second could be, okay, I've seen that my overall hit rate has been only say 40%, and therefore I'm looking to sort of improve that by looking at 2 confluences. Right, but that means now my trade setups for the day. So if I find 4 or 6 opportunities in a day, it comes down to 3 opportunities a day. So you need to find that balance. Yeah. When you mean confluence, do you mean a support resistance level lining up the pivot point? Yes. So what I mean by confluence is, a pivot level with a round number, a pivot level and your support level, a pivot level and a downtrend line. 3 pivots. 3 of the past days pivots at the same price level. That's confluence. Look, those are your different types of confluence levels. Yeah. Okay, so I think I lost my chain of thought there for a second. Okay, so that's done. Okay, so what's the next step now? Now that you need to work on getting the best hit rate, the best amount of trades per day, using different levels of confluences, whether it's 1, 2, 3 confluences. Then the next step after that is, how do I take the trade? How am I going to trigger and execute the trade? Now, trigger is what are you looking for? Yep. So now there's only 2 things you're really going to be looking at when you're on the trigger on the trigger phase. The first is price action at the pivot point. The second is the type of candlesticks you need. Okay, so let's just highlight sort of this move here. Okay, so price comes close to the pivot level. Now the question is, how close do you want price to be at the pivot level? Are you okay if it just comes within a pip or 2 of that pivot level, or do you want that perfect test of the pivot level? What if it breaks through the pivot level and bounces and it closes higher? Right, so you're going to look at what type of price action do you need around the pivot level. That's the first step of that trigger. Yeah. Then the second step is, okay, what type of candlesticks do I need? And remember, when I say candlesticks, I'm not referring to the previous candlestick or 2 candlesticks. I'm referring to anything from 3 to 10 candlesticks or 3 to 8 candlesticks. That's your range, the last 3 to 8 candlesticks. Don't need to go back and look at the last 20 candlesticks or 100 candlesticks. That's just pointless. Okay, candlesticks are there defining the short-term sentiment. Yeah. So, in this region of here, you might say, okay, price is moving. You can see how aggressive that selling off that is. Let me just try and really highlight this. Strong selling pressure. Okay, strong selling pressure breaks through the low, breaks through sort of this prior sort of low over here, consolidates, just ranges, goes sideways, a little bit more selling pressure coming through. So you can see larger red candles being formed, small bullish candles. or overall. Okay, almost a balance here. Then again, another large push coming through. This now sort of large. When you see these long wicks, what is the wicks defining? The wicks are defining more volatility coming in, more buyers and sellers stepping in at this point over here, being around the pivot level. Okay, and then it consolidates a little bit, and it's almost like a coil. Imagine a coil being squeezed, and all of a sudden it bursts, right? Sort of expands aggressively, and that's what takes place over here. So it doesn't really perfectly come to the pivot level, but read candlesticks, right? Read the most recent price action. That's key. You could take the breakout through this, you could take the breakout of this, and that will be your way of entry. Okay, so those are the 2 steps in regards to the trigger. Right, the type of candlesticks. Well, the first step is price around that indicator that you've defined your entry from. The second is the candlesticks forming and giving you the lead to get into that trade. And now we move on to from pre-market setup to trigger to execution. How would you execute that trade? Okay, execution is time or price filter. I cover this all the time with you guys. It's in your training manuals, okay? It's in your training programs. How do you go from, where do you start with? Do you start with trigger? Do you start, not trigger, sorry. Do you start with price? Do you start with time filter? You need to define that. It will be a whole new webinar for me to sort of cover what is time and price filter. I'm happy to do this, but you need to recommend this to me, guys. You need to define, no, I want to cover trigger, I want to cover execution levels again. How do I define the correct execution? But you either do a time or price filter. I'll quickly explain both. Price filter is just defining that entry price level, okay? So we got a price over here. I want to enter at spot 91.90. That's my price there. Put in a pending order if you like. That's where I'm going to enter, okay? Price is over here. I'm going to enter at 91.90. Yep, that's a price filter, right? But what if you have price go on to sort of get you into the trade, but all of a sudden it's a strong rejection candle like this, so you see a long wick forming and it closes lower and it continues to break lower. It's a false breakout, right? False breakout taking place. That happens. When that happens, that's when you then move on from a price filter onto a time filter. Okay, so you go now wait for the candle close. So I need price to be above the spot 91.90. In addition to that, I need the close of the candle. Okay, I'm not going to explain too much into it. There are pros and cons to both. There are buffers that you can add to it, and varying degrees of buffers you can allocate. I'll cover that on a different webinar. But yes, this is just covering sort of pivot points over here. Okay. Moving on. Now we're in the trade, guys. We're in this trade now. We're in this trade, right? Sort of, start to sort of moving in our favor. We're happy and so on. That's the next step, right, of that STEM process. It's management. How do I manage this trade? Let me just answer some of these questions here. How would tackle trading pivots in a trending market? Would you completely avoid using them? No, absolutely not. No, don't discount your. So how do I want to explain that in the correct way? And the best way to explain that is the fact that all indicators can be applied in different market conditions. You just need to be aware of the market condition. That's the biggest issue. It's often the trader themselves doesn't come to the trade, their trade desk in the morning, and I don't, when I sit there and I go through some of my assets, I'm defining what is this asset? Is this asset a trending asset? Is it a ranging asset? Obviously, some consolidation and contraction taking place. Are we seeing an expansion move taking place? Define the asset that you're looking to trade, and then once you know what you're going to trade, then you can apply the correct strategy according to that. And then, whatever the indicators are used with that strategy, you go ahead with that. Right? It's not, you don't go backwards, right? You don't say, I'm applying the pivot points, and then let me work out, is there a current trend, and so on, so on, so on. Yeah, it should be sort of the other way, right? This indicator can be easily applied where you see, I'm not sure if I want to touch on that yet. I can do, actually. It does come under sort of, the execution and management part of it, is the fact that how do I make my strategy better? If I see there's lots of false breakouts, it's not going in my favor, maybe when you're sort of doing that pre-market check, you apply a moving average, right? So I need price. I can only take a trade in line with that moving average, which means that I'll only look for buying opportunities when price retraces to one of the pivot levels, and because the price is above the moving average. So if I just add a moving average, just like this, right? So I'm only going to look for buying opportunity because price is maintained above this moving average. You might want to sort of a higher period moving average because all it is doing is it's a guide. It's a guide to define which direction you're looking to buy. You're not trading using the moving average. You're using it as a way of defining what is the current trend and which direction should you be going. Should you be going long or short? In this case, it's telling you you should be looking all for long opportunities. And there'll be times where you see price, you'll see price confirm onto both levels. It's come back to its moving average and it's at that pivot level also, which gives you a nice buying opportunity there. Right. Didn't really sort of trend any higher, sort of we started to sort of almost downtrend from that point. But that is an opportunity there as well, right? You want to look for those also. So let me just hide this. Okay, so I mean, under management, what is your steps, right? So that's where it comes down to reward to risk ratios. That's where you start to sort of, define where you're going to set your targets. You also define what type of in-trade management you're looking to do, whether you're going to be very aggressive or you're looking to sort of, slowly do that in-trade management, more conservative approach. Again, that's a webinar on its own, the in-trade management, and I don't have much time for really sort of, gone over sort of a 30-minute period. So I want to keep this short and sweet. Work on different ways of executing and managing those trades, and I'll cover those in a separate webinar in the future. But yes, that's your pivot point system there, guys. That's your pivot point system. Now, to sort of finish off on pivot points, two key points to sort of mention. Okay, the first is you're often going to have a lower hit rate. You should expect a lower hit rate. Okay, which means that your hit rate, what I've seen on average, has been somewhere between 20 to 40% in that range there, which means you're going to be wrong more often than right. Therefore, you need to get used to those losses. Okay, now where the strategy works out very well is in regards to reward to risk ratio. Okay, look for a greater than 3-to-1 reward to risk ratio. Okay, the higher the better. Okay, I've seen some really good reward to risk ratio, and that's what's going to sort of recover those losses and give you those additional profits. So remember, this strategy requires you to get used to taking quite a few losses, and you'll have back-to-back losses, but you've got to stick with the process. You've got to stick with the setups. Every time you see the setup, you've got to take that trade. Okay, so stick with the process. Keep taking those trades. Don't start the minute you start saying, "Oh, I've had 2 losses now. I'm going to stop. I'm not going to take this trade." That one trade could be the one that recovers your losses and give you those additional profits. So you've got to make sure you don't you're able to deal with losses. If you're not able to deal with losses, then this is not the strategy for you. This is not the strategy for you. Okay. So remember, you're going to have a lower hit rate, but you will have a better reward to risk ratio. If you're not achieving a good reward to risk ratio, then you're doing something wrong there. Your entry is wrong. Your stop losses are too wide. Your targets are not set to sort of the key levels. Okay. And the second point to finish this off with is that there will be plenty of opportunities on those lower time frames. On the 1, the 5, 15-minute time frame, there'll be plenty of opportunities. But you've got to look at multiple charts. Okay, you can't be just looking at one asset. You're going to be looking at, I'd say, start off with 4. Start off with 4. See how many setups you have. Okay, let me see if I can go to full screen setup. Where is it? Is it there? Yeah, so look at 4 assets. Have 4 assets there with the pivot points, all sort of ready to sort of roll, ready to go. That's what you should be looking to do. Let me just, what is going on there? I'll sort it out later. Wizard, there it is. Yeah, so get all the 4 assets ready so that you could take that trade. So start off with the 4 assets. Then if you start to see that you're only looking, you don't have enough setups, you need to sort of increase those assets. Yeah, so you can go from 4, then you can go into sort of maybe look at 6, and then if you wanted to, you could add 8. Okay, so it's up to you how you want to go about that. But you need to be looking at taking somewhere between I'd say 4 to about 10 trades per day. That's what I'll be looking for. I'll be looking for that range there, 4 to 10 trades a day. When it's a quiet day, you'll have maybe 3 or 4 setups. When it's a very volatile day, and there's volatility now, guys, there is volatility now. That's where you have maybe sort of 10 trades, per day. You want to be active. You need to be active because it's got a lower hit rate. You need more opportunities to be able to recover those losses that you've taken. Okay, so yes, look for more setups. Look at more assets on those much lower time frames. Okay. If the pivot points are close together, just avoid that market. It depends how close, right? It all comes down to your reward to risk ratio. That's the whole point of risk management, right? If you can, if you've got a tight, very tight stop, and if there's only sort of, I don't know, a 10 pip move, and you can have a 2 pips stop loss, and you've entered like a pip into it, and you still can sort of make a 3 to 1 there, right? So I'd say define that on reward to risk ratio. Okay, so I'll give you guys a minute or so. If you have any questions, please do ask questions. This is sort of, covering what is pivot points, how to apply pivot points, and how to sort of trade it using that whole STEM process. This is a complete market breakdown of pivot points, and we'll be doing more of these. So do ask other indicators you want me to go through, or if you want me to cover a specific part of trading, what's your morning process, right? What's your trade desk setup like? What's trigger? What's execution, and so on. And I can sort of cover another webinar into this. Are weekly pivot point less important than daily? No, I wouldn't say that. I would not say that. It's different to sort of gauge, right? So what I'm saying is the weekly pivots on those slightly sort of swing trading timeframes are less used than your daily pivots on these lower timeframes. Pivot points are there for for day traders, right? We're looking at it's a day trading tool. Started from those floor traders, then migrated to sort of the electronic trading style. So it's about the amount of sort of traders using that indicator. Does that mean it's less important? No. Would you combine weekly and daily to find higher probability setups? You can do. Yeah, it's up to you what influences, what indicators you want to apply. You could try, daily and weekly pivots. You can look at, daily with a moving average, daily pivots with a moving average. You can look at daily pivots with support resist levels, right? There is no right or wrong. There is only testing. There is only you finding what works for you. And always remember, don't try to over-optimize the strategy or over-optimize the indicators, okay? Because the minute you do that, that's when you may lose your edge very quickly. The edge is you. The edge is you applying a methodical process of indicators and analysis that you carry out these trades within a confined sort of risk guidelines. Okay, hope you enjoyed this, guys. I'll be doing more of these twice a week. And I'll see you on the next one. Okay, take care. Bye-bye.